morning, everyone. Thanks for coming. And I think the last time we were all together was during the start of the year. And the rest of the presentation will look into how we saw the year since January and give you some updates on what happened. Are we on track to our forecast? And I think offhand, we can say that most of our forecasts are still on track, and we continue to say that we are still positive on the Philippine economy and financial markets. And if you guys remember last year, our biggest concern was inflation. Everybody was scared of what happened last year. Interest rates started rising because you've been seeing and hearing inflation moving higher than what we've been used to over the last probably 3-4 years. So this year, things have changed. Things have gotten back to normal, and we expect it to normalize even further. So financial markets in the country definitely will be dictated by movements in interest rates again. So let's start with the overview, the positives and the negatives, what we see. First is in the US. We expect the US to hold off on their increase in interest rates. So that's something welcoming, especially for emerging markets such as the Philippines, where last year we were threatened by the fact that the Fed will start increasing their interest rates. Over the latter part of 2018, they decided to hold off because certain indicators show that they still need to help their economy grow before they can resume their interest rate hikes. So that is something positive overall. So the most recent event was the S&P upgrade of the country to BBB+. I know this is something not as concrete, but in the financial world, especially for the Philippine government, it means that it is cheaper for the country to borrow money because they're assigning a lesser risk in terms of credit rating. It just means that the Philippine fundamentals continue to be strong, and in fact are seen to even become stronger from where it is at the moment. That's why we received a surprise upgrade. In fact, nobody, including us, expected this credit rating upgrade. And mind you, BBB+, the next level is A. So if the government continues with their economic programs, we might see the Philippines becoming an A-rated country in the near future. So definitely that changes the dynamics on how the rest of the world will view the country. So hopefully we can see that soon. And then as we increase our credit rating, the country's interest rates definitely will have to take a pause as well, as with the entry of the new BSP governor. Him being more supportive of growth is expected to bring down their policy rates. Remember last year, the BSP has increased their policy rates by more than 100 basis points. And that has hampered a lot of borrowings. But for the normal investor, it has caused higher TD rates for banks. But for the corporation who would want to borrow and expand their business, it was quite difficult. That's why we saw a lot of pushback from corporates to borrow money because of the sudden increase in interest rates. But this year, as we see interest rates coming off as a result of lower inflation, we have been seeing more corporates borrowing. That's why the bond market has been quite active over the start of the year, as well as we're always looking forward to more issuances in the near term. So that would definitely help the financial market and bring down interest rates. So the BSP is continuously on an easing mode. And recently, they reduced their reserve requirement for banks. And what does it mean? The banks are suffering heavily from liquidity crunch because there are a lot of institutions borrowing money. Even the government's borrowing. So, and there's only a handful of cash available. That's why the banks are having difficulty getting deposits. That's why they're paying so much for us to be encouraged to deposit money. And with the RRR cut, the banks now can be able to free up about 100 billion amongst themselves per 100 basis points cut or per 1% cut. So that will definitely help ease the burden of banks from offering higher TD rates in order just to sustain their business. And in turn, that will bring down rates further. So what is the effect of this for investors? During the start of the year, we've noticed that most investors got attracted to fixed income instruments. Cash deposits suddenly became an asset again. Previously, nobody wanted their money in deposits. They all wanted to go to bond funds, equity funds, riskier assets because you need to have interest or earnings from your hard-earned money. But now, because banks started increasing their rates, people started moving towards time deposits at the expense of equity funds, bond funds. But now, we're seeing a shift back to all these equity funds, bond funds, because I think we have been seeing banks bringing down interest rates as an effect of lowering of policy rates and freeing up of excess liquidity or additional liquidity in the system. So, having said that, we would expect the additional liquidity to flow more into equities, equity funds, and more riskier assets in general. So that would definitely be supportive of the equity market. The GDP, I think the first year GDP was quite concerning and it was a bit disappointing, 5.6%. And a lot of the economists are pointing it to the budget impasse of the government, that they weren't able to pass the budget on time. That's why a lot of the critical infrastructure and the critical spending was held back. But now that's over. In spite of that, we continue to expect our GDP for the year to be at 6.4%. I think there will be a lot of catch-up, especially election spending will start to materialize second quarter and further expanding as the government will continue their infrastructure push towards the third and fourth quarter. So we probably expect GDP accelerating towards the latter two quarters. However, we are also mindful of some of the negatives. There's been a lot of talk that the US Treasury yield curve is inverting. And in history, if the US Treasury curve inverts, it is a signal of a recession in the US. But we are not of the view that there will be a recession coming in the US. It just so happened that there are certain mechanisms because of the quantitative easing that happened 5 years ago that caused the difference in yield curve inversion. In the next few slides, I'll show you why we think there won't be any recession in the US. On the peso, given the fact that interest rates will continue to go down, and the BSP is supportive more of growth rather than controlling the currency, and this has been expressed several times by the new BSP governor that he would want to let the peso trade on its own level. So having said that, we expect the peso to range at about 53 to 55 averaging about 53.20 for this year. The other thing that we are mindful of would be the trade war between the US and China. Has no real direct effect on the Philippines, but every time there are some talks on Trump or Xi Jinping making a move, the sentiment worsens and there's a sell-off in equities, in global equities, and of course the Philippines will be affected as well. But in terms of the direct economy of the country, we don't see any direct effect of the US-China trade war. Okay. Next. So first is, let's start to focus on the US, why we think there shouldn't be any recession. The job numbers has been continuously growing in the US. So the chart here, there's no pointer. This chart is showing the unemployment rate going down. And then this chart shows the total job openings. So over the last few years, you can see that unemployment rate has been actually dropping and the job creation has been growing. And the most important thing in the US, that's why Trump has been clamoring for protectionism, because he wants to create more jobs for the Americans. Because a lot of the jobs have transferred to China because it's cheaper there on the manufacturing side. But over the last few years, the program of the Trump administration was able to create more jobs, bring down the jobs, the unemployment rate. So definitely, if you have more jobs, there's more economic activity in the country. Okay. And again, this the job creation in the U.S. continues to accelerate from levels that we haven't seen even back in the 1990s. So definitely, there's been a lot of strong movement on job creation. That's why we don't see any recession happening because of this. And then the next is the Fed. Well, we expect the Fed to pause because we think that this move by the Fed will support more the continued recovery of the US economy. And previously, there's been talks that they will start to increase rates. That's why everybody was scared. There was a sell-off in the market. Even here domestically, interest rates started moving higher. And the peso weakened. Because if they increase interest rates in the US, the dollar will strengthen against all the other currencies. But suddenly, because the US is on track on its recovery, some of the indicators which the Fed is closely watching, for one, it's inflation, it hasn't really gone up yet. So they still need support. So they changed their tact. They said that, okay, let's stop and take a pause. So the whole market started to welcome this, especially risky assets such as equities. And that's why, in spite of the fact that there's been heightened concerns on the US-China trade war, the US-Iran, the nuclear and the oil embargo, US equity markets continue to trade at all-time highs. Even as of last night, they've been trading at all-time highs still. So this is really a testament that because interest rates will continue to move lower, and as an investor, the natural gravitation of money is to follow where the highest yielding asset will be. So they've started to move towards riskier assets again. And that's why equity markets in the US started moving higher. And this has an effect as well on emerging markets, because if you don't see much interest rates moving higher in the US, money has to flow to higher yielding instruments outside of the US as well. That's why we've seen equity markets, especially in emerging markets, started to rally, including the Philippines. Okay, so we're back to quantitative easing. As for those who still remember, it's practically creation of artificial liquidity in the system in the US. But last year, there were talks that the US will stop it. But now, it seems that the US will have to continue this in order for their economy not to slip into recession and in order for the economy to start moving up in its inflation forecast targets. Okay, so having said that, 10-year US Treasuries, we expect it to be at 2.5%, 2.6% from last year's view of about 3.5%. So a big change, and that big change translates to movement of funds towards riskier assets such as equities. Okay, oil. Again, this is a game changer, especially for the Philippines, as we're an importing country of oil. And it affects inflation if we've seen oil prices moving higher. Again, there's been a lot of problems in the Strait of Hormuz because of the fact that the US has had certain embargoes with Iran. And right now it has shot up both Brent and WTI globally. But we expect this to be a bit temporary in nature as there's still that stable supply of shale oil which can normalize oil prices. And based on our own models, the only way oil can affect Philippine inflation is if oil reaches $100 per barrel. So, and based on our estimates, we expect it to range between 65 to 85, averaging about $70 per barrel. So there's really not much effect of higher oil prices towards moving the needle on domestic inflation in the country. But of course, day to day and weekly, we have been seeing and noticing adjustments in the price of gasoline. But hopefully that will normalize soon as eventually we expect the supply of oil to normalize. Going to inflation in the country. Well, we have seen inflation peak from September's high of 6.7%. Now it has reached 3% only. So the inflation growth has really normalized to go within the government's 2 to 4% target. And a lot of this has to do with the stability of the supply of rice. And this is the biggest component of our food basket, which affected inflation last year. So a lot of that has been fixed by the government. So hopefully we won't see that spike in inflation again. Thereby, we can expect interest rates to continue to move lower as we see inflation move lower for this year. And in our own view, average inflation for the year, we expect it to be at about 3.5%. Further easing to next year to just about 2.8% on average. So overall, the concern on inflation is way behind us already. So we don't expect this to disrupt financial markets again, as a lot of the mistakes and a lot of the measures of the government has already been put in place to ensure that we won't experience what we've experienced last September. So that is definitely supportive of lower interest rates and thereby higher equity markets. Okay, moving to